All right, we've got a couple minutes here to go before we get started. Welcome everybody. Thank you so much for joining me. Today we are doing a live stream, so thanks for joining me live. We're going to be going over ETF investing with stock options on SPY. It's a pretty popular topic as far as SPY goes. People want to go ahead and buy into the SPY. Great for verticals. So today we're going to be talking about that strategy. And haven't done a live stream in a little while on this channel, so we're going to be doing more and more live streaming as we continue moving forward. I've been doing a little extra live streaming here on my other channel here that I've been looking at more charts and doing a lot more chart related things. So we're going to try and get a few more options videos as well, because I know with options they're a little more advanced and some people get confused. So I thought, let me dial it back a little bit and do a little more technicals, do more basics. So that's why I went with the other channel. So this one will be primarily options. Pretty much all options are focused 99% on options, and from here going forward at least. And then the other channel will be more basics. Hey, good afternoon, Mark. All right, so let's kick things off. We are about 45 seconds early, but I want to get started just to give you guys enough time to check things out. So market's behaving and acting a little wild here the last day or two. Doesn't matter what the reason why is. I always say it's irrelevant. You know, you might say, hey, it's coronavirus. You might say it's the Fed. Doesn't matter why. There's a lot of reasons. Some people might be afraid of the Fed. Some people might be afraid of the virus. So you got different people putting in trades at different points in time. Everything I talk about here, keep in mind, they're just, you know, my ideas, my opinions. They're not recommendations to buy, sell, or trade anything. It's just my own personal thoughts and insights. Okay, so let's kind of get started and let's take a look at investing in the SPY here. And as we look at investing in general, and we look at just the charts, just to show you a little chart, why are we going to talk about SPY? I think for a lot of people, there's a couple of big issues and problems. Is number one, the account size. That seems to be a little bit of a problem, is that, hey, we are going in with an account size of, let's say, if you have a $10,000 account size, you might say, man, just to buy some shares on SPY, it's a little difficult. Okay, so first off, why would we trade the SPY? Now, you could trade the SPX if your account size is larger and you get a tax break on that as well. But why would we trade the SPY? Well, number one, there's a lot of reasons. You don't have to deal with earnings, so that's kind of one big reason. Number two, not everybody is a day trader or swing trader, right? Are you a day trader, swing trader? Not everybody is a day trader or swing trader. Instead, they are more of a long-term investor. Okay, and that is kind of first. Remember, as you look at your basket of cash or money, you're typically taking the money you make, whatever your job is, and you're using the market to kind of grow your money, right? The market is there to help you grow your money. And this is kind of what I do here. Is for me, ironically enough, is I do the education side, and the money that I make here, I use to grow money. Other people, what they might do is you have a job, you have a real estate business, you make money from that, and then you can use other things to go ahead and kind of grow your money and income there in that way. But the point is the market there is for growth, right? So when we look at investing and we look at, you know, doing some trading as investing, in the options world, it's a lot more different than just maybe like day trading. So what you have to kind of look at it is that I need to repeat as a long-term investor, if I buy Apple, let's just say, I'm going to buy Apple and I'm going to hold it for, let's say, 3 years. That's what a long-term investor does. And as we look at it from the option side, I need to be able to do something similar for this to be able to make it work. So how would I do this in the sense of the world of options? Well, what I'm going to do is if I bought a vertical, let's just say I bought a bull call vertical spread, okay, and I buy one today, I can go ahead and repeat this process and keep buying it time and time again every 30 days, okay, and then again 30 days later, buy another one, and 30 days later, buy another one. So that's one way of doing it. But why would you do this? What's the reason of this? Is because this long portfolio, as we get into the bigger picture of it, this is part of the long portfolios. We want to repeat these trades. And you might have a lot of different things within your portfolio. So this one is, let's just say we're looking to repeat. This is our long portfolio because we're looking for long-term appreciation for growth. Now, you might be more of an active trader, and this is where you could get into iron condors, and making money from like theta trades and that kind of thing. You might also be a little more speculative, and you could have some day trades in there as well. You could go in and be a little bit more, let's just say, aggressive on the downside. So let's just say have some bearish trades in there. So you're splitting your account into different areas that money is being made in. So you could have money coming in from theta, money from delta, money coming in from all sorts of areas, however you want to allocate it. That's a personal preference. But here, what I want to share with you is that how do you become a long-term investor when you don't have a lot of cash or capital? And one of those ways is really just to doing verticals. So let me show you the strategy real quick to give you a big overview and see how it works, and then we'll break it down in a little bit more detail. All right, so here's what it looks like. So let's pretend that the market, and let me switch it to the big bars for you guys so you can see it. Let's pretend that we're going to go ahead and do something like this. I'm going to call it an apple a day strategy. So it's kind of like a SPY a day strategy. So as we go in and we look at these charts, just the way that they're behaving, okay, the market's kind of going up, down, boom, and then here. If we look at this as a long-term investment, right, a long-term process, we know that in general the market heads higher. Generally, right? Again, you might have periods of downtime, and if we keep backing it up, yeah, you got some nasty areas here in 2008, 2009, but logically, in general, the market is an upward trending basis, at least the SPY here in this case. Now, you could look at other stocks and so on, they might not be, but in SPY, it's generally moving to the upside. So what is it that we can do in order to invest in this? The problem here is, look, if I've got 462, so I've got $462 a share. Some people might say that's a little too expensive, because if I go in and I buy 400 and let's say $60 here times 10 shares, all of a sudden that's $4,000. Some people might say that's a lot. Other people, if let's say you want to go ahead and try and sell covered calls against it, right? You're trying to buy 100 shares. You got 46,000. Now you might be dealing with only a $10,000 account. So how is it that you can play this to be able to still be like a long-term investor? So if we know and understand that the market is already trending to the upside, what I want to do is create a strategy where I'm getting into this every single day, week, or month. And I'm going to repeat that trade time and time again. Yes, there are going to be periods of downtime, but I want to start spreading my positions out. Right now, you could go ahead and do something like this. Let me just go into a daily basis here. Is that every time on the first of the month, so that'll be right here, right here, right here. Let's go to April. Let's go to May. So you get the point, is that every time I can go in and buy, let's say, some vertical spreads, contracts, and I can do 10 contracts or 20 contracts or 50 contracts, whatever the heart desires. But you have to be able to allocate maybe 3 to 6 months worth of doing this, because at times you might actually get a drawdown. So you have to recognize you got to be able to sustain this for 3 to 6 months at least to make it kind of work. Now you could test your own theory. I kind of do a couple a day. So just putting on a little bit of spreads rather than buying the stock. You could buy the stock or buy the shares here. But if you put on a, like, well, let's just say an apple a day, here we have 1 contract a day. And you just put it on regardless of the price. Doesn't matter what the price does, because if you're a long investor, you're going to keep holding the stock anyway, right? So here, if we put on 1 contract a day, we know that eventually this will continue to kind of go in our favor, right? We're looking for the upside. So what we're doing is going to take a look at putting on a spread on the SPY right here, and looking to put on a vertical spread, a bullish spread, based on a 50-50 strategy. Those of you that haven't heard about this strategy before, I'll explain it to you in detail. All right, got a question coming in from Daniel. Why are you long biased the market in today's valuation and bubble? Do you ever create long-term short portfolio where you add each week? to your short positions? Yeah, you can. Look, just because you're long the market in the long side, the long term, right? Let's just say 5 years, you're looking for appreciation. It doesn't mean you can't be bearish for the short term, for the week, or for 2 weeks, because you could set up something like, let's just give a quick example. Let's say I am long the market right here, and I put one of these on the other day on the SPY, and you can see that's going down, right? And that's fine. You're just starting this position out. Now I've got 2 contracts going right here. But it doesn't mean that, hey, for the short term, what I could do is actually flip and pause my position. And that's what some people don't understand, is I could actually go in for 30 days. Let's say we're going to be bearish, and I've got a few contracts here. Let's say I got a delta of 10. What I could actually do is say, hey, let me neutralize this position. Now, I won't be able to neutralize it like fully, but what I could do is cut my deltas very quickly. Because why would you be long this market? Because the best time to be long is when other people are in a panic. When other people are selling off, that's when you're buying into these. Because when do you have the biggest rally? Is after a big sell-off. So look, what's happening is now I could go in and buy a few shorter dated 3 contracts right here, vertical puts, and now basically this thing goes left or right. I don't make money, but I don't lose money either, and you're just hitting the pause button. So what you're trying to do is go in and let these things to kind of work and grind their way to the upside over here, because that's the objective, is I'm trying to get this vertical spread to get it to climb up and grind into this area, and once it's there, I can either hit the pause button or take off one of these contracts or 2 of these contracts. Because what's going to end up happening is called a risk array. We're going to be going over a class about this after the new year. For those of you that signed up for all the classes about a month or 2 ago that have done a few of the classes. But what we're doing is we're going in through the creating a risk array where we're going to have trades lining up, you know, 1 contract here, 1 contract here, 1 contract here, 1 contract here. Because what the issue is with a lot of people is what they do is they go ahead and put like 20 contracts here in this one spot at this one strike, and then the market goes down against them, and now they get taken out, okay? So now what I'm going to do is I'm going to show you this example as how would I build out this position. So now what you could do is, let's say the market's going down today, and it's a perfect opportunity again, is that, look, I'm looking to add, and my objective is to maybe get to about 100 contracts. My objective is not to make money on day 1. My objective is to spread this out, to spread my chips out into different baskets. And I'm going to go maybe 60 to 90 to 100 days, 120 days. I won't go too far out, but I will go maybe at least 60 days or so, because I got to give that probability a chance to kind of work in my favor and to catch up. If you go too short of a duration, you might not give price a chance to wiggle. If you go too long, the theta that happens and kicks in, it's a little too slow. So somewhere around that range. If you feel like maybe more pullback will come, what you could do is go a little longer duration, like 157, 185. So here's our spread setup. I'm going to go to the 107 for now, just to do a different expiration here. And what I'm going to do is I'm going to do a spread kind of right at the money. Now, you'll know that with the SPY or SPX, these are kind of like the indexes. They're actually skewed a little bit. So you don't get a perfect spread like a 50-50, meaning like cut in half, where you make 100 to lose 100, and these are a nice spread where you're actually able to take the full loss on the position, but I'm spreading out like 100 of them. So it makes more sense. So if you look at a stock like Bank of America, why am I hopping to Bank of America? Because the spreads are very good, and you'll be able to see why this is kind of like a make 1 to lose 1. So it's a 50-50, right? I'm trying to make about $100 on 108. So look, I'm risking 108 here to try and make 92. It's a 1-to-1. So if you do a vertical put, on the other hand, what you're doing is actually your total risk on here is much greater. So if I'm selling a vertical, people say, or a 9 condor and that kind of thing, I'm basically trying to make 23, but my risk is actually 77. The risk is much greater, the total risk. So what you have to be able to do is, when you're dealing with something like the SPY, you got to be able to be comfortable, because it's a 50-50 strategy. You got to be able to be comfortable to take the full loss on this position. So as I go in and start spreading this out around the at the money area, why would I do the at the money? Here's the big thing. When I do something at the money, okay, it's not going to have much of a theta or a vega problem. When you're dealing with like an iron condor, when you're dealing with butterfly calendar, all of those will have some sort of theta or vega problem or benefit. Now, if you do it with a benefit, you're going to have the other problem, which might be more margin, more capital. So here, let's say now we're going in and we're buying a vertical. Okay, so here we go. We'll buy a vertical kind of right at the money. I'll get rid of this other one as an example. So now I'm kind of looking to risk about $250 to potentially make about 146. So you can see the skew is not exactly a one-to-one as it is on maybe a stock itself, because typically there's no earnings here, it keeps going up, so the skew's a little off there. So what you could do is move it up about a point or two if you like, a little bit out of the money, but you don't have to. You could kind of leave it one-to-one. But here you could say, hey, I'm risking 250 to about make 150. So it's pretty close. So you have to be able to take this full loss. But remember, I'm starting to stack my chips in different spots. So I'm going to have positions all over the place. So my objective is that eventually that this will start climbing to the upside. So now what you'll do is you'll go ahead and you'll fill another one in here to put that position on. And what you might do is that if the market is very, very strong to the downside, you could actually add 2 times on the downside on a red day and only 1 time on an up day, or every 2 up days you add 1. So your strategy might be different, but I'm just giving you some thoughts and ideas to play with here that you could say, hey, I could take this and use this as a concept for my own personal investment style. So what did this just do to me? Okay, so if I look at it from an investment perspective, okay, rather than buying shares of SPY, I'm buying the stock as a synthetic of 3.5 delta or so of SPY. So it basically gives me 3 shares of SPY. In other words, 3.5 shares. So I'm looking at it from 3.5 shares. I could take this calculator, because 3.5 shares for me at a price point of, here it is, 462. 462 times 3 shares would cost me about $1,300. However, here I'm risking about 244 on the risk side, but I'm able to make about 150 on it. The other way is if I do it with the actual physical stock, I can hold it forever pretty much, get a dividend and that kind of thing. In this case, I'm able to kind of micro allocate. So I could do 3 shares here, 2 shares another day, 3 shares another day. So it's kind of like you put 1 a day. An apple a day keeps the doctor away. Here, a little bit of SPY a day will get you an investment of a risk profile picture that's different and spread out all over the place. So you can see I put these on the other day when the market was still toppy. I still did it. I put it on, and I put them on at the same spot because it was too close or close enough. And then the move down, and here I am down about $57. Now I've added another one, so now my total delta between these is 14. And what you'll notice is this expiration. As you start spreading out the expiration, you can see you've got risks at different break-even points. So with time, what's going to happen is this 107 will start moving, and the 94 will start moving. You'll start getting other options in here. So you'll trade probably somewhere between like a 60 and 120. You could go to 150, and you're going to start spreading out your risks. So what I could do is start spreading this out even more. So let's say it starts to go against me or in my favor. Now this spread might be a little different. So I'm going to start adding another one here for you guys so you can see it. And what we'll do is now we'll do one somewhere in between here. So when you're doing this spread and creating it, you got to make sure you give yourself some room. If you do it too tight, like let's say one versus the other one, because this is $1 spreads, you're not going to have enough wiggle room or room to really make any sort of profit, or there's not enough range because these are such tight bid-ask spreads, or bid-ask spreads and also strikes. So what you might do is, okay, I'll go in now. Let's say we've got another one that's kind of moving. Let's say it keeps moving. I'll go and buy this one, and then I'll sell this one. So now I'll go in, and I could even confirm and send. I'll send that one in. So you can see it's working there. I've got another spread, 3 to 4 points, 5 points, depending on what you feel. And as it keeps going, you could say, okay, I'll get another spread going. Okay, so then I'll put another position on, and I could confirm and send. So now what you'll know is, okay, as this keeps going, I know that which one is tied to which position. So you can't see it exactly right here, but what you'll see is as I move this over, this one is tied to the first one here, this one is tied to the first one here, and this one's tied to that one. So they're all tied together. So I could actually now start evaluating every single one of these kind of individually. So I could go like this. I could go now to the next one. where I'm looking at this one, and then I'll go to the first -1, and I could see that one, how it's doing, and I'm trying to spread the risk, okay? And what's great about this is then, as you start going into 3 or 4 expirations now, and you do one a day, you're going to allocate your price levels at a lot of different points. And you could say, hey, on a big down day, I'm going to go ahead and just add 2. On a up day, I might just add 1, and I might do it tighter on an up day, maybe because the market's already moving forward a little bit more. So the point is that you don't want to allocate everything on one day. And it's just like, hey, I'm just adding 3 shares a day, 3 shares a day. That's all I'm doing right here. That's it. Very simple approach. But as a long investor, the point of this and why it would work is that you go ahead and you're doing something every single day, just like a long investor, because you can't replicate it in options. You can't replicate the same concept in options without doing the option side a little different. You have to then buy the shares of stock. And the problem then with the options guys is what they'll do is they'll buy like 10 or 20 or 50 contracts in one day. So rather than doing it that way, you could just do 1 contract a day, right? Micro do it. Just put 1 a day, just like you brush your teeth every day. If you do a habit, you have a habit, 1 a day, you just do 1 a day, eventually it'll go up and your risk is allocated all over the place, right? That's the point, and that's the whole goal and objective. All right, Baziri says, it makes a lot of sense. I believe one can buy more when the price is at the low point, even if it can be spread through different low prices. Yeah, you can buy more if it does go down. Like on a big down day, what you could do is, like here I've got a working order. So let's say on a big down day, what I could do is say, okay, I'm going to do 2, and then you'll know which ones you've actually added also on a big down day. So that way, as you look through your contracts when you're doing this, right there I got filled. So as you look at now your contracts, you can say, okay, this is just a way to manage it. I've got 2 here and 2 here. So the 2s are the ones I added on a big down day. The 1s are the ones I've added maybe on a big, on an up day rather than the down day. So now what you're doing is allocating a little bit differently based on the direction of the market or based on the movement. And what you can see right now, even here, the market now is grinding up slightly. So here we go. Let's just pull up the SPY. And this one is real time, by the way. Normally TC2000 is 15 minutes delay, but I do have real-time data on it for most things. So you can see right here, look, after we sell off quite a bit, you'll see that snap up a little bit. You'll see the volume coming in. You'll see it picking up. It's not anything big, but that's the point, is that you're trying to get it to snap up. And what you're trying to do is slowly take profits into strength. So as these come in and these start becoming profitable, okay, so like these 2 I have, they're not profitable, $57 down. I'm okay with that. That's fine. But out of 100 contracts, I'm not even there yet. Out of 100 contracts, I'm going to get there. So the ones that I just put on, these 2 right here, they're up 92 cents. I'm starting to get there, right? You're going to keep adding, and you're starting to do this. Here's another one, let's say, again, not profitable there, but I'm trying to spread my risk out. And this is just one part of your portfolio. Because what a lot of people do is, okay, I'll just do this one thing, and that's fine. But remember, you'll have this part, that's part of your, let's do it this way. You'll have this basket, that's your long portfolio, and you might do this strategy for the long portfolio. Then what you'll do is maybe, if you like, again, I'll move to something completely different, day trading. If you like to day trade, you can day trade. But then that's another part of your portfolio. Then you have maybe another part of your portfolio doing like spreads or something else. For theta gain, money every month kind of thing. Theta. So you'll have a lot of different things spread out at different points and areas. My point is that this is one part. You have other parts that in total will make your full portfolio. So what a lot of people don't typically understand is, how do I do a long portfolio or a long investment with options? And this is one way of doing it. Now you can go outside your brain and come up with other ways, but if you're a long investor, you're basically holding that stock through good times and through bad times. You're trying to collect your dividend. You're trying to do what you need to do to be able to keep holding it for a long period of time, because you're a long investor. In the options world, the problem we have is the time decay and that these things expire. So how do I make it work? How do I make it function? Well, I could do diagonals, I could do bullish iron condors, I could do vertical spreads by selling verticals, or I could do vertical spreads like this. And I find these types of spreads, these 50-50 option spreads, are really good for a lot of people because what you're doing is you're risking 1 to make 1, or risking 200 to make 200. And what you're doing, if you're doing it on Apple, it's no different, is what you'll do is I'll set up the spread and you'll go in with 1 contract today, 1 contract the next day, 1 contract the next day. So maybe let's say 45 days. If you like to be more aggressive on the swing, you could go like a 30-day, 40-day, 50-day. You could do a 20-day. You could do a 10-day. But my point is that if you're more longer term, you might want to go like, 30, 40, 60, 90, 120 days even. So let's say on today, I might say, okay, let me start out with a 66-day. If I want to be a long investor in Apple, I have to make a conscious decision. For the next 3 years, 2 years, I'm going to be doing this strategy, and I believe in Apple over the next 2 years, just like somebody that buys stock is going to do it. I could do a couple contracts every week. You determine your time frame. I could do one every week. I could put a trade on. I could put a trade on once a month, or I could put one every single day or every 3 days. Whatever your time frame is, you decide that. But here's what I'm doing is now I go ahead and I'll put in 1 contract right here. And this is kind of a 50-50 spread, but the strike price is not, it's not exactly in the middle. The price is not exactly in the middle right now. So you're going to get a little bit of that skew. But look, you're risking 265 to make 235. So I'm risking 265 to make 235. So even if this blows up in my face, it's not too bad. Now, if you had a $10,000 account, can you ramp this up to, let's say, more contracts? Absolutely. So what I can do is start going up to $10,000, and here I'm risking $9,275 to be able to make about $8,000, almost that same $9,000. But this is a highly leveraged vehicle. So would I do this? No. If you're dealing with a $10,000 account, remember, you're going to still spread all these out at different strike points, but you still would probably only want to do this like with half of that position size. Because remember, as it starts going against you, you are going to start stacking negative theta, and you'll have some vega that'll start to increase. So as they do start to go against you, and you'll have a lot of overlay here, what you might want to do is start getting into selling some spreads to be able to cover and finance the theta. That is something to look into. So if I was to start this position out now, let's say, hey, we're on a down day. I'll do like 2 contracts at a time. I'll spread out a little bit here. Okay, so I'll throw in, and I'll just throw a couple spreads in here just so you guys can see. So I'll do 1 in February, 1 in March, 1 in January. Let's just show you kind of how all this plays out. And what you'll see is my delta is going to start growing. So I might do 1 contract here, 1 contract here, and I might even do, let's see, 165, 170, and I'll do this one at 175. Let's see, that one won't work as much. 180, 175 here. So I've got a couple spreads at different points right here. So I'm going to start putting these orders in. So there's 1, there's 2. And again, you're looking at doing this maybe every single day or once a week on every Wednesday. You pick the date, whatever works for you. Hey, good afternoon, Kevin, by the way. So once you've got this going, and if you have an issue with any of these, let's say you've got a negative theta that starts to creep in, what you could do is start, again, getting some positive theta to work against it. So let me get these filled here for a second. And, again, popping in a little bit here on the price just to speed up the video. Okay. And you always want to do limit orders, just let the trade work. You could have this thing sitting all day. Like sometimes I'd have these things sitting all day and they never get filled. And then the next day you might get filled at a good rate, because I've seen different people, what happens is they get really bad fill rates. And I've seen people lose 6,000, 7,000 just right away from a bad fill order because they're trying to do like 10 contracts or they go market order. Don't do that. Especially on stocks like Amazon or something big like that. So now I've got these at different points and different positions. You could see these different verticals, but in the end, all I care about is, look, I got about 17 shares of Apple. That's what I'm talking about. That's what I'm looking at. And if this continues to go down, I'll buy a couple more, because this contract right here with these, I've got about 10 shares, okay, from that spread. from this spread right here, I've got about 6 shares, right? This one's more of a kind of selling a put vertical. Even though it's calls, it's basically selling a put vertical because I got a little bit of theta, okay? And you might want to mix these around to be able to cover some of that theta if it starts going against you. But what you're trying to do is ultimately build up to your size or your lot, and I will say about half of what you normally think, because you need to be able to sustain if this thing blows up. Like let's say these at 175 blow up, because here's what we're doing with Apple. And we're looking at this price point. So I've got now contracts at 175. I might get some at 170. So as this pulls back, I'll get some at 160. Chances are this stock's not going to zero, right? That's my thinking, is if the world's going to blow up, I'm assuming that then everybody's going to lose out. But I'm assuming that the world is not going to blow up. I'm assuming that this stock will not go to zero. And in that case, by around the time I get to maybe 150, it's going to probably be a good value buy. So I need to be able to sustain one a day normally to be able to handle this. If you start seeing it roll over, could you pause and wait? You know, could you wait for 3 days? For it to kind of calm down a little bit, or maybe, you know, isolate a little bit? Yeah, you could. So wait a couple days and then go in and buy another 1 or 2. Because your objective is when this thing's heading down, like look at it right here. Let's say you started at the worst possible time and you were trying to get to a lot size of about 100 of these, okay? Or even the amount of days here. So I've got 1 day, 2 days, 3 days, 4 days, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. So I've got about 20, 23 days. My average price would be somewhere around here. And eventually I'm going to break even. Okay, and eventually, as I look at that price about 147, okay, that stock price still went above that level. So here's my price at around 147, right, about averaging at the worst possible time, and that stock price still got above that 50-50 spread. So, and this, here's my about 30 days. Let's see, here's 30 days, here's about 60 days. So that gives me enough time. So take a look at your spreads and strategies. I want to share this concept with you because not everybody gets the concept of longer term investing when it comes to options. But the point, there's a couple key takeaways here. And one of the big takeaways is that you're going to go ahead and do the, number one is the same vehicle, stock, or ETF. So you'll just repeat. So you have to repeat it. If you don't, you're just getting out at a loss. And then again, you're hopping to another one while the one you got out at the loss is starting to head higher. Number two, look at kind of a Apple a day strategy. Okay, so this is the same concept of buying the stock and holding it. But you're looking at an Apple a day. It could be per week. It could be per month. But I will say on a monthly basis, you're maybe less allocated. So at least look at maybe a weekly, maybe daily, maybe every 2 or 3 days. Look at a 50-50 strategy from a vertical standpoint, and that is because the amount you risk is about the same as what you make, okay? So when you're looking for, hey, I'm going to risk this much, I'm going to make that much, it's about the same, which means you have to be comfortable with a full loss on some of these, okay? So when any of these pull back, you got to be comfortable with a loss. But I'm okay with some of them being losers because I got 100 of them going, or maybe 200 or 500, whatever your size is. So you have to be comfortable with the full loss. When you take profits, okay, take profits at about 50 to 60% of the full max profit, okay? So if you're trying to make, let's say, 200, maybe by about 150, you'll try and take profits. Why? Because, you know, when you get to about 100, 150, so you get $100 to $150 in profit, right? That's about halfway. When you get to that level, what's going to happen is that stock is going to be stretched. Once that stock is stretched, it has a higher chance or tendency to pull back. So you might see it on some of the spreads maybe that I have. Let me see if I've got anything interesting here. I got Home Depot, Disney, Peloton. Let me see if any of those have anything. Okay, so here's Home Depot that I bought or put out, you know, again, paper trading with my coaching clients, mentoring clients. By the way, those of you guys that are joining me, thanks again. So this one was purchased way earlier, right? And you could see it's a protected vertical in case this sells off, but it was going higher, you know, because that stock was toppy or frothy. It looked just very high, but it's still going well. So the time to take profits, and I leave some of these going just to show examples, I need to take profits on this because the most I can make is 318. The most Right now I'm making 242 on that spread, but why didn't I take it off? I only got a couple days to go. But the reality is if I'm making about 200 bucks and that stock did go up in my favor, right now you could see the market has changed. If you look at Home Depot, this stock was going up, 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 up. And now, look, it hasn't fully went down, but look, when it's really toppy, yeah, you take profits. So don't let those trades go against you. So when these verticals, they start going up in your favor, like here's SPY. Again, now look, the market's up, where are we? Now we are 37 points. So 3.6 on the SPY. So it's still going up. Look, that's exactly the point. That's exactly what we're talking about, is that in this live market situation, here's the SPY. Let's look at these individual ones positions now. And we'll kind of go into some questions if you guys have any. So here again, this one was down, I think, 60 some dollars. Now it's only down 55. Okay. Again, little positions. These are little positions. You don't have to trade big. Big does not mean smart. Okay. And spreading your contracts out all over the place is actually way smarter than doing 100 right off the bat. Here, look at this one, up $8. Doesn't seem like a lot, but remember, multiply this times 100, 1,000 contracts. You could do 2 contracts a day, you could do 5 contracts a day, whatever your size is, but you got to have enough to allocate throughout 30, 60, 90 days. Okay. Then here's the next one. Okay. So I'm looking at, okay, here's the other one, up $1.23. Not a lot. It's pennies, right? But this starts to add up with time. Here's my Apple one that just got filled. Another one. See, let it come to you. Then we'll look at this next one. Here's this one, and then I'll go to that one. Okay, this one's not doing anything. And then we've got these two right here. Look at that, making another $2. $2 here, $2 here, $2 here, $1 there, 40 cents here, 40 cents there. That's what you're doing. Boom, boom, boom. Taking a little pennies, 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 pennies. That's smart in terms of the marketing, in terms of the market. Okay, don't put everything in one basket and drop the basket and you've got broken eggs all over the place. That's not the way to do it. Okay, let's look at Apple real quick. I don't know where we got filled on, but here we go. So same thing here, $4. Look, you're up $4 or $5. That's all you're trying to do. And this is, you're starting to spread things. This one isn't as spread as much. I just did it today with you guys. But you get the idea, I think, is we're trying to spread our price action at different points. Okay, if you do it all in one spot and you go in big, let's say I've got 100 contracts at this one spot, I might win, I might lose. You might win big, but you might lose big. Spreading it out like this allows you to be a long-term investor without buying the full shares, especially if you have a smaller account. Like for example, here you've got 10 delta, which is basically 10 shares of Apple. If I go in and allocate or look at all of these, I've got 33 delta, which is like 33 shares. So I'm just slowly building my position. And if you do this across like 1 to 2 to 3 months, now you're starting to see more of the results. Okay. But you got to be comfortable with going into, multiple time frames of holds with these positions and building it up. If you're struggling with your delta being too high or you don't have enough capital, reduce the distance between your strikes. So here, if you're looking at it on the spread and the position here, if you've got a distance of normally, let's say 5-point spread, you might say, okay, I'll do a $2 wide spread. So instead of that much, I might do just a little bit. If you want to reduce it that way, you could do it in that case. Or if you're struggling and you won't be able to do 100 contracts, maybe you're only able to do like 20 contracts, then what you can do is instead of doing it daily, do it every Monday and Wednesday, or do it every Monday. If that's all you can do, then that's where you're at. Just start with what you can do. But I hope this gives you some taste or insight of how you could be a long-term investor when it comes to trading options or just investing with options, because a lot of people, they don't get it, they don't understand it, their risk is out of whack and they're hopping around trying to do some quick, fast strategies. Remember, this is just one component of the bigger picture. You might have a portfolio, and as you look at this, as I deal with my mentoring students here, you might have speculative day trades, you might have weekly trades, you might have theta trades. I don't have any right now. You might have swing trades, you might have long portfolio that you always have, and that you're just doing time and time again. And then as you start building onto these, like Apple, what is this going to go into? Probably I'll move it to the group and I'll put it, like, let's say, into the long portfolio, SPY. I'll move that back to the group here. So now I'll keep building this asset class with time, right? So I'm building these long portfolios, And then I can add some swing trades. These are maybe like, hey, one-time trades for 30, 40 days that you see breakouts on. You might have theta trades that you repeat where it's like iron condors and butterflies, non-directional trades. You might have like weekly trades that are short, but again, also could be theta trades. And you got some speculative stuff. Maybe throw in something like here. Here I got a cruise line, Norwegian stuff in there that I put on, you know, $40. No big deal. You throw a little bit here, a little bit of money here, a little bit of money there, a little bit of money there, and it's coming in together. And that's what you're trying to do is create a composite portfolio. That's what a portfolio looks like, you know, because a lot of people, what they'll show you is they'll show you a lot of the speculative stuff, and it's like, oh, I made $1,000 a day today from doing that one stock. Yeah, but you put all your risk or a lot of risk in one position. That's not smart money management, usually from a risk management standpoint, at least not from the mentors I've learned from over the years and personal losses and stuff over the years that I've had. So anyways, thanks for joining me. Hope you guys enjoyed the little clips and insight. Truly appreciate it. If you have any specific questions, let me know in the chat, and then we can kind of close it up and let you enjoy your evening. All right, Baziri asks, hey, how you doing, Baziri? Does it make sense to sell calls when the price range is on the high side for SPY? As an example, this is to maintain the leverage. Yes, you can. Even if you're dealing with verticals like this, you can sell the calls to reduce your delta on the short term. So let's say I've got all these positions going and I've got a delta of 24 and I see a downward market. I can still sell calls, and I could do a shorter duration, because if you do longer duration and you sell calls, it's not going to benefit you as much. I could do like a 20-day. Shorter term, I might be bearish, right? Because let's say, ooh, it's really high. So shorter term, I might be bearish, but longer term, I'm still bullish. So I might say, okay, for 20 days, let me sell some calls against what I have. And what I can do is go here and go to a certain delta, like a 20 delta or something like that, and then sell call verticals against that position. So now, look, what I can do is take my delta down from, it's currently at 24, right? My delta currently right here is 24. So now what I can do is sell verticals against it. Again, this is gonna look very messy, but all I care about is really this delta number. Okay, so now it's gonna be 11, and then if I keep going, I could be a 4. So if the market starts to go ahead and tank, really, I'm looking at right here, and look, I could change this expiration for you guys, make it more smooth. So look, I went from a kind of a vertical position spread like this, kind of like long stock, 24 shares, to then cutting it and say, hey, the market this week is going to be super weak. It's going to be toast. It's going to be a problem. So I could actually convert it to a temporarily a negative position to protect and put a pause. It's like hitting a pause on a VCR, if you guys remember what a VCR is. I do. We used to watch cool movies at that time when I was a kid. Lion King and other stuff. Anyway, so here it goes on the downside. So temporarily, I'm just hitting the pause button. And once it starts heading back off, maybe I'll lose a little bit on these calls that I sold. And then I'll let my longer term positions go back, keep going, heading higher. And that is simply because I got too many positions at that point to be able to get out of them and get back in them. You could cut some, like take some profits on some that have worked really well as well. But other than that, what you could do is, yeah, you could cut that delta, just go to like -9 just to temporarily pause it. It's only going to help you a little bit, because then what you'll have to do is keep rolling the calls closer, just like you are with the other side on the bullish end. But you'll keep cutting that delta with periodically. So it's just putting a pause, like a little break, tapping the brake. All right, Daniel asks, when you buy and sell an iron condor, does it have to be a market order? No, it does not. Limit order for sure. How do all the contracts execute at the same time? Do you leg into it? No, you don't have to leg into it. In fact, you'll get a better bid-ask spread if you put it together. The market can only, it doesn't matter which broker you use, the market can actually only execute 4 legs. And I could do any 4 legs that I want. I could go like this. I could go 2 of these. I could sell 1 of these and buy 1 of those. So what you could do is you could create your own whatever 4 legs. Anytime I start going a 5th leg, it won't let me because the whole market system, they can only execute 4 legs. And the market makers, they don't really care what you're doing. Sometimes the complex spreads are more of a pain, but all they're looking at is the numbers and what they have to do to hedge against it. Because what they're doing is they're looking at your position and they're looking at, okay, he's got 65 delta 18 theta, and Vega, negative 43. So on their screen, what they're actually going to see is they actually need to now hedge 43 Vega because they're on the opposite side, right? They'll be negative 18 theta and negative 65 delta. So they have to hedge against this. So they'll usually do it with stock and that kind of thing against it. But for you, as for an iron condor, you can leg into it if you get a big drop and you sell put verticals and then you snap up, and then you can get the other side like 3 to 5 days later or a week later, depending on the duration that you're doing the iron condor. But normally you'd want to do it all at once as a regular limit order. You don't want to do market orders. I've seen people get into iron condors on Amazon, and I'm talking about real accounts, like the mentoring and coaching I've done. Usually it's a one-off phone call, meaning somebody like calls me and says, hey, how come my iron condor looks weird? And it looks weird because what happens is they might set up an iron condor on Amazon. And let's say this iron condor on Amazon, I don't know, let me just throw one quick one on here as I start building one out. Boom, boom. Okay, so here's an iron condor. It says, hey, they're going to get a credit of like $5.52, but they only get like a credit of $2.30. And all of a sudden, the next day, they're like down like $200 or even $2,000 right away. So I've seen it down quite a lot because the price fluctuates and they get it at a really bad fill. I've seen butterflies on Amazon. Like there was one guy, I don't remember the exact name, but I don't want to mention it either for privacy reasons. But let's say it was around like $2 for a butterfly, but he got filled around $20 because he did a market order. And they're like down like $8,000 from the start or so, depending on the contract sizes, just because of the bad fills. So you definitely want to make sure you do limit orders on option spreads, especially big stocks, just in general. If you want to get filled in it fast, just bump up your price a little bit. That's it. Hey, Jeff. Hello. Is it possible to apply such strategies on stocks with low option liquidity? You can, Jeff. The problem with low liquidity stocks is the filling. So I will tell you, I have trouble, and I'm talking about live money. Paper platforms, they get filled a lot better, just because they just kind of look for certain triggers and then they fill you. But stuff like Daku, even though the volume is big, the option volume is a little bit lighter. I don't like trading it. I've done it multiple times, but man, every time I do it, it's tough fill. Same thing with Etsy. You can see right there with the volume. And if you look at just the options, the amount of open interest is kind of light. And then with the other one is like CMG. So all these stuffs is like, you know, the $2,000 burrito. The liquidity is tough. So you could do this strategy. The problem, or the way that you could get around this, is that you might need to wait for your order for 3 to 5 days. So for example, if I was doing something on CMG and I wanted to deploy this strategy that I talked about for you, so let's say I'm going to 94 days. Does it really matter if I get filled today or tomorrow or the next day? Not necessarily, but I need to then really have an order in. So what's going to happen is I might go ahead and go right at the money right here and get this spread set up like this. So now I've got one kind of, I'm trying to not lose more than 485, and I'm trying to make about 515. Okay, so really about half of that. But remember, this thing will only go to zero at expiration. So even if I get out over here, you know, just kind of let it 7 days or less, you take this trade off, right? At 7 days, just get it off. So here, as I'm trying to play with the trade like this, what I might do is, even though it tells me I can buy it at 480, I might go in and say, okay, let me do this trade, but I'm going to do it at 460. And I'd let that sit. Like these low liquidity stocks, you'd let it sit for, you know, a day or two. The big issue is going to come down to when you need to exit, because getting in is not the problem. It's getting out. So if you've got like 200 to 400 contracts you're trying to build into, that's where the issue could be. Because if you're the one with 200 contracts and you're dealing with something like this, let's just look at the 3-day right here. There's only 30 contracts here. Now, if you're dealing like 5 contracts, that might be fine. But if you're trying to build to a lot size of, you know, 100, 200, I would do it more in a liquid vehicle. With this stuff, yeah, you could do like a 5 contract lot, but you might only do it like once a week then, because the liquidity is a little bit of a problem. Getting out is usually the issue, not getting in. Getting in, they'll take your order, but getting out is usually the problem. Hey, Daniel, will you ever use an iron condor for a scalping strategy, or is it only for long term? No, you can use an iron condor for scalping, but I would be a little bit different. So if, sorry, I typed in iron condor. But let's say I was doing the Moderna here and I wanted to say, hey, for the day, I'll do the iron condor. And you could do it. I could do an iron condor for Moderna. I could do it for like 3-day theta scalp. Boom, done. I could do it also for a bullish iron condor. So if you never heard of a bullish iron condor, I could do it for a quick pop and then expire. So here's an idea for you. So let's say I sell this one 280, 275, and then I'll buy like a 300, 305. And now what I've got is a quick pop and expire kind of setup. So it's a little bit of a different kind of scalp or a little bit of a different speculative position, but these are speculative positions, right? It's more of like a one-off trade. It's not a recurring long investment. So you have to make sure that you understand the big difference behind that. Most people don't get it. Remember, we've got different baskets. This could be like a quick, scalping, if that's what you're talking about. It could be like a pop and expire. You could do one kind of at the money as well for just an expiration or something like that, or just for a quick theta. So yeah, you could use iron condors for scalping. There's nothing wrong with it. You just set it up a little different. This one does not have puts and calls. It has only calls because it's a scalp to the upside for a quick 1 or 2 day pop and then expire after that, right? Or close to expiration. You might not even want it to expire. You might say, okay, let me get it to go in there. Once it's kind of in this zone after a day or two, what's going to happen is this time frame is going to kind of blow up a little bit. So if it gets in there, you take off most of your money, $200 out of 300. So you've collected the majority of your money, right? You probably wouldn't want it to expire because, there's a lot of risks involved with it whipping against you. You just kind of want it to pop and then expire, get to expiration within a day. Take off a day of theta. And that's the whole point. That's kind of what you're trying to do with maybe something like that. Hope that helps, Daniel. All right, anything else? Otherwise, we will wrap it up. And I truly appreciate you guys sticking with me and doing some live events. We're going to do some more of these here coming up in the future. Feel free to check out the other channel that I have here. I just started this not too long ago, this last week. This is going to be all technicals for charts. On this channel. So I'm doing more like indicators and doing individual stock analysis on this channel right here. So you can check that out at Critical Charts just to do something different, because what I find is a lot of people in the options world, so this channel, this TRADERSFLY channel, is going to be all options, and really from here on forward I'm going to really focus on options. But I find this is more like, more the advanced people or intermediate. A lot of the YouTube stuff, I always say the YouTube things I teach are actually basic. For me, they are basic. So when you get into courses on my level, for what I teach, my courses, I can only speak for mine, I would say they are intermediate. And when you get into coaching and one-on-one, we go take it to your level or advanced level. So what I've done with this secondary channel here is I've taken it to more of a basic level, stock concepts, charts, and I find that's kind of where a lot of the newer people hang out, or people who are more into technical analysis. So if you're kind of into that, I'm going to focus more on technicals over on that side, and some more of the fun videos over in that area. And then this one will be more of the option side. Hey, Daniel, thank you so much for the kind words. Truly appreciate it. Say you're a great educator. I try to be as detailed as I can. That's my end goal and focus. So anyway, thank you so much, guys, for joining me. We'll do some more live streaming periodically. I'm going to also test out some things where you guys can also hop on and ask questions or more detailed questions about your personal situation. Usually, nighttime is good for me, but today's session, just based on what I was teaching, had to be done more on screen here. So anyways, this is kind of what you do with a portfolio. That's what a real portfolio looks like, right? None of these day trade, single, one-off strategies. You're going to have a bunch of different stuff in here. Now, if you're dealing with a small account, you might just choose one thing here and just do like the long investments, and that's it. And remember, the market is there for you to grow your money. A lot of people try to use it as a full-time income, but that becomes a little difficult. So find whatever you do, whether you're an electrician, plumber, AC repairman, whatever money you make there, then you're using it to invest your money. For me, I run a couple of different businesses, and also the education thing. I like education. It keeps me smart from, kind of like playing chess all the time. It keeps me active with you guys. So I like interacting with you smart folks, and keeps my brain active. And then I take that money and I invest it in that way. So everybody has their income source, and then you're kind of investing it. A lot of people think, hey, I just want to make it my full-time thing. And it's great, but prove it to yourself first, because then you might not be able to just do the investment part of it. Now you're just trading to be able to live your life. So split it up a little bit and make sure you can balance your psychology as well. And that's why I kind of do a couple of other businesses as well. Personally, we usually have multiple things in our life, whether it's chess, yoga, kids, martial arts, tennis, bowling, whatever you're doing, keep it going to balance yourself out in other aspects of your life. Anyway, thanks for joining me. Enjoy the rest of the week ahead, and I will see you guys